Hello everyone, welcome back to the channel. Today we are talking about something very important for every salaried employees, the new EPF withdrawal rules for 2025. The Employee Provident Fund Organization or EPFO has introduced major changes that will make it easier for members to withdraw their savings when needed, while also ensuring that retirement funds remain protected. These rules were approved recently by Central Board of Trustee and they will impact every EPF member in India. So let's understand what's new, what's changing and how it will affect you. To start with, the main aim of the new EPF rule is to simplify the withdrawal process. Earlier there were 13 different types of withdrawal provisions, each with separate condition and paperwork. Many employees found this confusing and time consuming. Now, these 13 categories have been merged into three simple groups: essential needs, housing needs, and special circumstances. Essential needs cover things like medical treatment, marriage, and education. Housing needs include buying, constructing, or renovating a home. Special circumstances refers to situations like job loss, natural disaster, or emergency. This simplification will make it much easier for employees to apply for withdrawal without getting stuck in complicated rules. Another major change is about how much you can withdraw. Under the new system, members can now withdraw up to 100% of the eligible balance, which includes both the employee and the employer's contribution along with the interest earned. Earlier, withdrawals were limited mostly to employee share, but now the entire amount can be accessed in certain situations. For example, if your total PF balance is rupees 6 lakh, you can withdraw up to full amount if you meet the required condition. This change give employees more flexibility during emergencies or major life events. The service period requirement has also been made simpler. Previously, different withdrawal purposes has different service requirement. For some, you had to complete 5 or even 7 years of service before you could withdraw. Now, most categories have a standardized eligibility of 12 months of service. This means that even new employees who have been working for just a year can make partial withdrawals for important needs like education, marriage, or health expenses. This is a big relief for those who may need funds earlier in their careers. Now let's discuss the rules for unemployment and final settlement. Under the new policy, if an employee loses their job, they can withdraw 75% of the EPF balance immediately after leaving employment. The remaining 25% can be withdrawn after 12 months of continuous unemployment. Earlier, the full withdrawals was allowed after just 2 months, but has now been extended to promote long-term saving and prevent premature depletion of funds. For a full and final settlement of your EPF account, the waiting period has now been increased from 2 months to 12 months. Similarly, the Employee Pension Scheme (EPS), the waiting period for full withdrawal has been increased to 36 months. This ensures that people keep some savings for the future rather than withdrawing everything at once. Another very important update is the introduction of mandatory minimum balance rule. Under the new system, members must keep at least 25% of their total EPF balance, including both employee and employer contribution plus interest, in their account even after partial withdrawals. This is a protective measure designed to make sure employees still have some money left for the retirement. Data in the recent years show that almost half of all EPF members ended up in less than rupees 10,000 in their accounts at final settlement, which is not enough for retirement. The new rule ensured that some savings remain untouched for long-term security. The withdrawal frequency limits have also been made more flexible. Earlier, you could withdraw for certain purposes only once or twice during your career. Now, for education, you can withdraw up to 10 times and for marriage up to 5 times during your service period. This offers more convenience and recognizes that life events like education and family responsibilities may arise more than once. The process for submitting claims have also been simplified. For many withdrawals under special circumstances, you no longer have to provide extensive documentation or detailed explanation. This reduction in paperwork will make it faster and easier to receive your money. So, what do these changes mean for you as an employee? In simple words, the new EPF withdrawal rules give you more control over your own money. You can access your savings more easily when you need them, whether for education, healthcare, housing, or emergencies. At the same time, the rules ensure that you don't end up using your funds too early, which could leave you with nothing for retirement. It's a balance between flexibility and financial safety. Let's understand with a quick example. Suppose you have been working for 2 years and unfortunately lose your job. Under the new rules, you can immediately withdraw 75% of your EPF balance to meet your expenses. The remaining 25% stay in your account and can be withdrawn after 12 months if you remain unemployed. This means you get quick financial support while still keeping some savings safe for later. Similarly, if you are still working and need funds for your child education or wedding, you can make partial withdrawals more easily now and even use both your and your employer's contribution for it. Here are a few important tips you should keep in mind. Make sure your UAN universal account number is active and your KYC details like Aadhaar, PAN and bank account are fully updated. This ensures smooth and quick claim processing. Before applying for a withdrawal, check your total balance and remember that you must always keep at least 25% in the account. If you plan to switch jobs or take a career break, plan ahead because a final withdrawal is now allowed only after 12 months of unemployment. It is also a good idea to use only the official EPFO website or the Umang app for claims to avoid fraudulent activities. In summary, the EPF New Withdrawal Rules 2025 brings a mix of freedom and discipline. The rules have been simplified from 13 categories to just 3. The waiting period has been standardized and the withdrawal process has become much faster and easier. At the same time, the government has ensured that employees maintain a minimum saving balance and that the retirement purpose of fund is preserved. These changes will benefit millions of salaried individuals across India by making the EPF more flexible, transparent and secure. So if you're an employee contributing to the EPF, take a few minutes to review your balance and understand how these rules apply to you. Being aware of these changes can help you plan your financial better and make smart decisions about when and how to withdraw your money. That's all for today's video. If you found this explanation helpful, don't forget to like, share and subscribe for more updates on personal finance, salary rules and government policies. Drop your questions in the comments. I'll be happy to answer them. Thanks for watching and I'll see you in the next video.